Once we have all of our inventory budgets done, we can move on to our selling and administrative expenses budget. So these would be our period costs. We have a variable selling and administrative expense of 50 cents per unit. We have monthly expenses of $70,000 per month, and 10,000 of that is depreciation. So we take our budgeted sales. So again, where we go back to that sales budget that we created at the very first budget, times our 50-cent per unit rate to get our variable expenses. We add our $70,000 a month of fixed expenses, and then we subtract the non-cash expenses to get the amount for cash outlays that ends up on our cash budget, which is next. We move on to the cash budget, and that gets divided into 4 sections. The first section is the cash receipts. So this is all the money that comes in from sales from customers, excluding cash received from financing. And then we have all of the cash payments we plan out, except for those of principal or interest on loans. Once we look at our cash receipts versus our cash disbursements, we know whether we're going to have excess cash or if we're going to have a shortage. If we have a shortage, we need to do a short-term loan. And that brings us to the financing section, which includes any details about loans and repayments for our cash outtake. So now here we have information about our Royal Company. We have an open line of credit for $75,000 at our bank. This means that anytime we have a cash shortage, we have cash available for us at 16%. We require a minimum cash balance of $30,000. That means anytime our cash is below $30,000, we're going to take a loan against that line of credit. We borrow on the first day of the month and repay loans on the last day of the month. We're planning to pay a cash dividend in April, and we're planning to purchase equipment in May and June. We currently have a cash balance of $40,000. So we start with, what is our cash balance of $40,000? And then we add our receipts from customers. That gives us our total cash available. We then take all of this information off of our different budget schedules. So off of the direct materials budget, we have our cash disbursements for materials, the direct labor budget, the manufacturing overhead budget, and the selling administrative budget. We also know that we're paying a cash dividend. So we are going to be short. We're going to end up with a cash deficiency of $18,000 at the end of April. That means in order to meet our minimum ending cash balance, we need to take a loan out for $48,000. Then when we have excess cash, we'll pay that back. So you can see in June, we have this excess because our May sales were so good that we received more money than we had for disbursements for June. We can repay that loan plus interest. So we know that we took out $40,000. So come back to principles 1, that we take amount times rate times time to get interest payments. So we borrowed on April 1st, paid on June 30th. That's 3 full months. So 48,000 times 16% times 3 divided by 12. And that gets our interest rate. So we pay back our financing and have an ending cash balance. And for the total quarter then, we have what our beginning cash collections were, our total cash collections, cash available, disbursements, and then our ending cash balance. After we've created all of these schedules, we can create our budgeted financial statements. So we start with a budgeted income statement, and we take information off of our other budgets. So this is the budgeted income statement for the entire quarter. We take the sales off of the sales budget, the ending finished goods inventory for the cost of goods sold. We have our numbers from the selling and administrative budget and our interest expense from the cash budget. After we have a budgeted income statement, we can create a budgeted balance sheet. So we have other information about our accounts that we haven't received from our various budgets. We create a balance sheet. So we have the $80,580. That's our ending cash balance from that cash budget. The accounts receivable comes from the cash collections budget. Our raw materials inventory and our finished goods inventory come off of the direct materials budget and the finished goods inventory budget. The land and equipment information was given to us. Our accounts payable is from our direct materials purchases budget. And our retained earnings takes our beginning balance plus our net income minus the net income off of our budgeted income statement minus that dividend payment in April to get our budgeted balance sheet. And all of those schedules and financial statements are part of a full master operating budget. That is the end of chapter 8. As I said, in chapter 9 and 10, we're going to look at the controlling aspect where we compare actual results to budgeted results for our organizations.